Hello everyone and welcome to this very important video. And as you know, here on this channel, I'm analyzing Tesla and I'm unlocking my own ability to invest in a stock that I think is going to change the world in a much bigger way than anyone thinks right now. My personal model, and I think it's a pretty smart model about the future cash flows of Tesla, considering the robots, considering robotaxi, looks at a share price conservatively of $10,900 by 2030. So that's in 5 years. And I have a little valuation model or compound annual growth rate model that shows me or helps me to understand what actually happens when Tesla reaches certain share prices right now. And I'm going to share some of that here just to kickstart this video and you understand why we are talking about leveraged ETFs. So in this share price model here, basically it's a very simple model. I'm plugging in 2030 my target valuation, and this is not investment advice. This is just my own model that arrives with a 10-year discounted cash flow perspective at $10,970 per share, not considering any splits by 2030. And this model helps me to plug in a share price right now, for example, 430 today, tells me the compound annual growth rate to expect, like 91%. In case you didn't know, that's a crazy growth rate, right? So we would make, if that is true, if we reach 10,970, the stock in average appreciates 91% per year for the next 5 years. Okay. That is why we are talking about this opportunity. I think there is no other stock in the market in the world right now, at least not for me, based on my knowledge and understanding of the world, that offers such an enormous return at super low risk. And when I say super low risk, this is my personal assessment. Do your own research. But my personal assessment is that the probability on first principles that Tesla will not unlock Optimus, the robot market, and Tesla will not unlock robotaxis within the next 24 months is incredibly low. It's an incredibly low risk. And the next reasoning is if they unlock this, it's going to be so massive that people do not understand how massive. Robotaxi will be trillions of dollars in margin eventually. But Optimus is going to change the face of this earth, the face of human civilization, the power balance between nations and geopolitics like nothing has in the last 200 years. Because robots, humanoid robots, are going to power nations like nothing else. You can overcome your biggest bottleneck as countries like Germany or Sweden or South Korea or Japan, but also China, Russia, US. All these countries have a labor problem. They have a labor cost problem. The more advanced the country, the higher their problem is. For example, in Germany could grow at 5, 6, 7, 8, 9% a year if they wouldn't have the labor cost problem because they have such great IP and they have such great innovation power. Same with Japan, same with South Korea. So Optimus solves all these problems. That is the reason why we are looking at insane returns once someone cracks the humanoid robot problem. I also believe Tesla has a huge leg up over the Chinese competition for a very different reason than people understand. And that different reason is that there is a national security thing connected to humanoid robots. Even if China pulls off something as good as Optimus or better than Optimus, do you think Germany, Japan, or South Korea or America is going to replace their entire workforce with Chinese humanoid robots and puts in hundreds of millions of Chinese humanoid robots into all their factories? Meaning it takes one press of a button in Beijing to shut down your country. No, they're not going to do that. And they're going to prefer Tesla and regional manufacturers like Tesla. Tesla is very regional at this point. They're in Germany, they're in US, they're in China, over anything else. So long story short, I'm not going to go too much into all these fundamentals. There are different videos on the channel. That's the reason why this is such a low risk, complete disruptive opportunity. Now, here comes the thing. If you have the level of conviction that I and many others have in that price point, and let's say you have a certain amount of money, let's say you have roughly 1,000 shares, let's say $400,000 in Tesla, and that's all you can afford, that's all you have, you make 91%. But of course, you think, well, there is basically very limited risk long-term here. There's risk short-term that this drops 50% or 30% because it can always happen. But there's very low risk long-term, incredibly low risk and incredibly high return. So what triggers that in any greedy capitalist mind, like all you guys, you traders and you investors? It triggers the idea, can I just not put on leverage? Okay, now that is a brilliant idea, of course, in theory, because if you could put on, a 2x leverage, if you can generate 100% alpha over your 400,000, if you can effectively put down 800,000 without having it, by borrowing 400,000, here's what would happen. Instead of making $10 million by 2030, if that 400,000 would be 2x leveraged, you generate 100% alpha over your Tesla return. Instead of $10 million, you make $71 million. So a simple 2x leverage leads to $60 million more you make over 5 years. Or in percentage points, 600% more. So that is why we even go there into that territory and become greedy. Now, there are tons of caveats. This is incredibly dangerous, and you can lose all your money and all these things. But why would people take this risk? Because of that. 71 million is better than 10 million. 10 million is very good based on 400,000, but that's the reason. So now we go into that territory and start thinking about leverage. Okay, number one, if you do hardcore leverage, you borrow 400,000, you have many problems, right? If you have a capital stock of 400,000 and you borrow 400,000 against it, what does it mean? Well, first of all, you pay interest through your nose. If Tesla goes sideways, well, you lose a lot of money on interest. But that's not the real problem. If Tesla drops 50%, you are at zero, right? If Tesla goes up 100%, you go up 200%. But if Tesla drops from 400 to 200 and you are 2x leveraged, your portfolio goes from 400,000 to $0 because you lose twice as much, right? Just do simple math on it. And so that means you're not even getting there. If Tesla drops 25%, you get margin called all over the place and you get squeezed out of your position. And if Tesla drops 25% and then jumps back up to where it started dropping, you look very bad because you got squeezed out, you lost all your shares, and when they bounce back, you have much less shares and you can't do anything about it because you don't have money. In short, leverage looks amazing when it goes up, but when it goes down, it's horrible. And it leads to people who are just in a volatile stock and they are leveraged and they don't do anything about it. The odds that they come out very poor on the other side is very high. The simple reason behind it is you cannot stay leveraged 2x. But if you would have a ability to borrow 400,000 against 400,000 and have 800,000 and just buy Tesla shares and close your eyes, go to sleep and wake up in 2030 and be guaranteed that you have the same number of shares of Tesla in that portfolio that you got with your 800,000 2x leveraged. Everyone who's a little smart would do it because the risk then would be incredibly low. But the odds that on the way, while you sleep, this portfolio gets destroyed and your broker sells all your shares or a lot of shares. And when you wake up, you're much poorer than you would have been if you would have been leveraged, is very high. Okay, so what's your next option besides hard leverage? Your next option is to play with stock options and construct leverage with stock options around the shares. That gives you much more leeway, but it's very exhausting and it's also very dangerous. If you do any mistake and there's a big drop, you get destroyed even more if you are not cautious. I think doing options as opposed to hard leverage is always preferred for those who are very knowledgeable and who are on top of their game. That's what I'm doing, but it's very dangerous. And so I got these questions from you guys. There are these magical holy grails out there, the magical holy grails, and these are leveraged ETFs. So these guys, and I want to talk about these guys because it sounds like the holy grail. You can't do hard leverage yourself, you get destroyed. If you do options trading, it's going to be, good luck with that. It's not the easiest. And so why don't we just do these magical things? For example, like Direxion, Tesla Bull 2X shares. You can also, if you're a crazy bear, you can do that. So this thing promises you, well, we will look into what it actually promises you. But at first look, it looks like, well, this is very easy. It's an ETF. Here's the ticker. You buy this thing, and it's constructed in a way that it has a daily target of 200%. So it's kind of 2x leveraged. So instead of buying $30 of Tesla, you're buying $30 of TSLL. And if Tesla goes up, let's say 1%, this thing is designed to go up 2%. Tesla goes up 10%, this thing is designed to go up 20%. And if Tesla drops 10%, this thing is designed to drop 20%. So why is this at first look so intriguing? Because it looks like your problem is solved by these guys, right? You're basically saying, oh, I don't take on the risk. I don't take on leverage. I don't take on options. I'm just buying the ETF, go to sleep for 5 years. I wake up, Tesla is up, let's say, 2,000%, but my ETF is up 4,000%. Isn't that great? Or theoretically much more because it would compound, right? So, well, there's a problem. There is no holy grail and there is no free lunch. In other words, all the problems we just discussed that you have doing 2x leverage, what do you think this fund, this ETF has? It has the exact same problems. It cannot do magic. So this fund has the exact same problem as you would have. They cannot trick physics, the physics of capital markets. So these guys get equally destroyed. They could equally not maintain their fund, and they have all these problems. So to believe that they have a magic wand where they can remove the leverage problem, they don't. And if you look into these funds, and Direxion is one of the most established ones, right? You have others like Granite funds, where's this? It's here. Granite shares 2x long Tesla. So I have multiple here to look at and to explain what they do. So first of all, if you look actually into their description, they say something very important. They say that they are designed to have a 200 or 2x leverage daily. So what they promise you is if Tesla goes up 1% one day, they say, well, they don't promise anything, but they say we design it in a way where we try to achieve an exact 200% of that, right? 2x. So why is this important? Let's first look at the performance. Today, Tesla is at 432. So Tesla is up 2.7%. Let's make sure that's actually real time. Oh, it's actually up 1.7%. Okay. Let's look at TSLL. How much is that up? It's 3.53. So that's not bad. 1.7, what is twice that? That would be 3.4. So this thing is up 3.5%. Well, this sounds pretty good, right? It's pretty close to 2x. The other one is 3.34. Okay, also nearly 2x. But now let's look at the year. They got lucky this year, I tell you right now. Year to date, Tesla is up 72%. So you would expect these two, who are 2x leveraged, to be up, 144%. You go here, say, how much is it up? It's 118%. By the way, that's not bad. You can be happy. But it's up 118%. Why is that? Why is it up 118% if it should be 144%? So clearly it's not 2x leveraged. It doesn't work like that. How much is this up? Year to date, the Granite shares, they're 91% up. So wait a moment. Tesla is up 72%. You are 2x leveraged. You are up 91%. That's interesting. How is this 2x? How is 91 2x of 70 or 72? It's not. And you have to consider this is a good year. So what would happen, if Tesla is down 10%? Are these things down 20 or are they down 40 or are they down 50? So you can already tell. This is not a little off. This is dramatically off. 92 is not 100% more than 72, even though Granite Shares has a fund objective of 200% daily. Okay, so why is that? Because they cannot play any tricks. They have to work like me. Right? They have to start doing option constructs around it, and they do certain things. They do actually the opposite of what I do. They do more, let's look at this, how this actually works. So in their prospectus that no one ever reads, you guys just buy ETFs and never read the prospectus. This is not good. So what this says, right? The fund's performance, this is from Direxion, but same thing for Granite. The fund's performance for periods greater than one trading day will be the result of each day's returns compounded over the period, which is likely to differ from 200% of Tesla's performance before fees and expenses. Compounding has a significant impact on funds that are leveraged and that rebalance daily. The impact of compounding becomes more pronounced as volatility and holding periods increase. And I tell you, a year is a long holding period for a daily optimized fund. And will impact each shareholder differently depending on the period of time an investment in the fund is held. Okay, so now they become even more specific. They're actually required to provide you this table, and that is exactly what helps us to really understand what's going on. So this table is very important because this table tells you what the truth is. In this table, let me zoom this in even more if possible. In this table, we see the actual Tesla return, right? A theoretic 200% return, the volatility rate, and the actual return of that fund expected, right? Okay, so what you see here is if Tesla, 1 year performs at 0. So it's a flat year. And volatility, which means how much Tesla oscillates around, like the amplitude. Tesla goes up a lot and then goes 400, 600, 400, 200, 400, 500, 300. That's high volatility, right? Whereas low volatility means, 400, 410, 440, 360, 380, 400. So that's the volatility rate. Now, what you see, the return of this fund, and this is a 1 year return, looks like this table. And what you see in this table is this has nothing to do with 2x leverage. Nothing. It's completely not 2x leverage. Long term, right? And you want to hold long term holder. So the question is, can you hack your Tesla holding by buying an ETF that is leveraged? And the answer is pretty much no, you can't. Because if Tesla would be flat for 1 year at high volatility, right? So Tesla shares jump around, which they often do, you would lose 63% at super high volatility of your investment. So if Tesla starts at 400 in 2025 and ends at 400 in 2025, and you invested $1 million, you only have $370,000 left. Whereas a Tesla shareholder who has 100% in Tesla has $1 million left. So this fund is not 2x leveraged. It would have a negative alpha, absolute alpha of 63%. It would lose money through the nose if you do that, if Tesla doesn't move, right? So what happens if Tesla, and you can see the red is underperforming, the green is overperforming Tesla, which is interesting, right? So if Tesla goes up, for example, here, Tesla goes 60% up, which is probably goes up more next year. The fund goes up 153%. So here you achieve a leverage that is higher than 2x, but only if Tesla goes up 60% and at very low volatility, which when does that happen? Never. So Tesla goes up in a straight line, then this fund makes you actually more than 2x. But if Tesla goes up 60% in a year, so your $1 million in Tesla would be 1.6 million if you would be invested only in Tesla. If you invest in a 2x leveraged Tesla fund and it goes, 60% up with your $1 million, you end up losing $58,000. So if you invest in this fund, 2x leverage, and this is super high volatility in this year, and Tesla ended up 60% up, instead of owning 1.6 million from your million initially, you're now owning, only 942,000. So that's very depressing. So as you can see, this is a much more complicated game, and there are no tricks. And I tell you one thing, if Tesla goes up in a straight line 60% in a year, I make you easily 500%. Low volatility and stock up. I mean, how is this even hard? You just buy, tons of call options or sell tons of put options, and you just make infinite amounts of money. Everyone can make infinite amounts of money if that happens. And it never happens. And as you can see here, all this management of leverage just destroys this fund if there's a high volatility. And now you also see something interesting on the downside. If Tesla drops 50%, in theory, you get wiped out, right? Because you were 2x leveraged. So in theory, if Tesla drops 50%, you should lose your entire capital stock. But you never do that in this fund. Why? Because that fund is designed by definition that it can't do that. It cannot lose all its money because it's not allowed to. So here, if Tesla drops 50%, you only lose, even at high volatility, you only lose 90%, which is not good, but just saying. So they have a buffer in here, and they have a special, option strategy how to prevent this, which costs them performance. But you're basically approximating zero. You're never going minus 120% because you can't lose more than you have. So here you see this table just tells you how complicated this game is, and it tells you that ETFs are not the holy grail, because why would they? They have the exact same problem every trader would have to construct this. The big takeaway is don't blindly buy ETFs that claim they are 2x leveraged Tesla, because they're not. And they also technically don't claim that. They claim that they are 2x leveraged Target on a daily basis for day traders, not for long-term investors. Tesla's volatility can easily reach 50, 75%, or even 100%, right? And you see the consequences here. Tesla is up 50% year up, and you're losing 17% potentially in this fund instead of just making 50%. So, in the sideways year, you get completely destroyed. You get literally destroyed. Minus 10% to plus 10% sideways years in Tesla. Look at this mess, right? You're losing 40%, you're losing 50%, you're losing 70%, you're losing 31% when Tesla is up. You put $1 million in Tesla and you end up at 1.1 million if you don't touch this thing. If you buy a 2x leveraged, Tesla goes up 10% and you lose $300,000. So that's why you have to be cautious. And I understand it looks pretty good right now. If you bought these things in the beginning, you're up 92%. You think, well, 92 is better than 72. Or if you bought Direxi and you were up 120% instead of 70, you're very happy. But this was a lucky year. It was a nice year. Next year, you don't know what's happening. And look what Direxion tells you in their prospectus. So what is the morale and the takeaway from all of that? There are no holy grails, and you have to be a little cautious. No one can trick capital market physics. And capital market physics is you cannot just be leveraged. Even if you're completely right long term, leverage can destroy you in between. And no one can get around that fact, unless you have tons of money and only use a subset of that money to perform only on a Tesla portfolio. But that's stupid, because that means your total portfolio is not performing the way you want. So I hope that was helpful. There are no magic tricks. If you're completely certain, like I am, that Tesla is going to go very high, figuring out how you make more than 100% that Tesla makes is not easy and requires a lot of knowledge, and generating sustainable alpha on a single position is hard. And there are no tricks. There are no ETFs who just solve that problem. So I hope that was helpful. I just had to address that question. Here we are looking always at this channel at the fundamentals of Tesla. We look at the fundamental developments. I use a 4-dimensional approach where I look at technical movements, I look at the fundamentals, I look at the macro situation, and I look at Elon geostrategy, because that is important, what he does in politics and with countries. This will massively impact Robotaxi and Optimus. And then we skew towards the fundamentals. We understand when the milestones are coming in. We understand the price targets and where the stock has to go in the long term. And then we try to generate some alpha by looking at macro and the technical. So I hope you enjoyed that. Merry Christmas. And I hope to see you very soon.